Greetings, friends. Keith Prather here, and I just want to give you a very quick automotive update. We're recording at the early part of June and covering the May data. Let me share my computer screen here real fast with you. Very good. So this month's Automotive Demand Index came in a little bit weaker than expected. So April dipped to 60.9, which was down 2.9% month over month. It was still remained 4.8% higher year over year. So there is still some decent demand in the marketplace. And as you can see on a historical basis, even though we have seen a little bit of softening and it is down from the peak that we saw in 21 and 22, rates are still, somewhat on average, and we're a little bit better than what we saw, just prior to the pandemic, kind of between the 2014 and 2018 period, and then a little bit of a surge in 18. But this would be considered to be a more normalized demand environment. Now, again, it is a little bit concerning that we did see a little bit of softness coming between March and April. And I think we can start to pinpoint kind of where it's coming from. Let me advance here. I'm going to continue to point back to this one data point, and we're going to be watching real disposable income over the next year. Real disposable income is just inflation adjusted income that's left over for consumers after they pay taxes and a lot of essential spending. And the Federal Reserve calculates this data. It's been stable over the decades. And even though it's kind of tough to see in this particular chart, when you do correlation studies and we look at automotive sales, they're most closely related and correlated to what happens with real disposable income. And frankly, when we look at all of the big ticket purchase areas, so we look at marine and boats, and we look at power sports, we look at RVs, we look at all of those sectors, these big ticket purchases are really driven by inflation adjusted disposable income and how available that is to consumers. So we're watching this trend. We do get this every month, and the latest data shows that it had been growing at just a 1% rate year over year. When I did the recording last month, it was growing at 1.4%. Now, the forecast for 2024 still show a 1.4% growth rate, and then we're kind of expecting the same thing in 2025. But for many of the dealers that I talk to as I travel around the country and as we have Group 20 meetings, one of the things that we noticed is that obviously this feels a little bit different from 2023 when we had real disposable income of about 4.2%. So that change in the growth rate is really where a lot of the deceleration is coming from when we, think about it on dealer lots, when we think about the actual moving of units. So that's really the backstory. And the squeeze is not necessarily coming from the income side. Wages in the United States are still growing right now around 4.1% as of the latest data that we got through May. And so that's a little bit faster even than what we saw in the April data when it was growing at about a 3.9% annual rate. And with inflation today somewhere around 2.9%, even though that's higher than the Fed's target rate of 2%, there is still a pretty decent gap between wage growth and overall inflation, which will help most households start to build a little bit of momentum if a lot of these conditions continue. But what's really starting to weigh on disposable income is higher tax burdens, not necessarily at a federal level, but what we see at a state level, a lot of retail sales tax increases, a lot of impact from that, and then a lot of impact from general inflation on things like home insurance, auto insurance, mortgage rates, a lot of those really kind of eating into disposable income. So that's really the backstory, and I think that's what's creating a lot of pressure in the market, even though we see, decent job growth activity and, some other economic metrics that would seem to be creating a much faster growing economic environment. But when we look overall and we think about the OEMs and think about production, this is not probably representative of the entire industry, but auto inventories relative to sales continue to be fairly slow. And you can see that at least auto sales, total vehicle sales at an annualized rate and at a macro, national rate are still holding their own, still doing okay. A little bit weaker than what we saw prior to the pandemic, but a little bit stronger than when we were coming out of the Great Recession. So again, we see it jogging sideways, which is still pretty good overall story for the automotive industry. Now, our forecast looking forward are showing it flattening out. The good news is, and I'm going to jump to the third point here, but the good news is that they're flattening out at a pretty elevated rate. And so this is auto production, and this is looking out over the next 18 months. So it's not necessarily what's happening on the demand front. That's what the ADM index is for, the ADI index is for. This is more for understanding kind of what the OEMs are looking at and what auto production is going to look like. And so moving forward over the next 18 months, again, kind of flattening out. Now, a couple of things that we do watch is, number one, that flattening, but number two, we do watch this cone of variability, and the statistical models that we use look at and find instances or scenarios based on economic data and economic forecasts that are painting potential for upside in this industry that would cause a pretty significant growth rate. And then the downside here would look like a fairly good drop, but on a historical basis, it would not be significant. It's not calling for like an automotive recession or a recessionary pressure building. And again, this would show us any scenarios that it was painting that would show a very negative dip. So nothing like what we saw in the 2008, 2009 period, nothing like we saw during the lockdown, and even nothing like what we saw during the global supply chain crisis in 21 and 22. So again, the demand outlook looks like it's fairly stable overall. So just summarizing this and wrapping it up, we still think Q2 is going to come in a little bit hotter than this 1.7% growth rate. And this is real GDP, inflation adjusted, just to show you how fast the macro economy is growing. Right now, current estimates show it growing at about 2.6%. So we think the actual growth rate is going to come in somewhere between 1.5% and 2% for the quarter, which would be hotter than expected. And then for Q3, we're still expecting 2%, and then Q4, 1.3%. General growth for this year should feel about like 2%. And if you compare it to where we were last year, it's pretty much in line with 2023 and 2022 growth. So overall, macroeconomic conditions are still pretty conducive for some decent growth between now and the end of the year. Again, as we've talked about many times, though, I think there's going to be different segments of obviously the U.S. economy and households in the U.S. economy that are going to continue to show these really robust spending patterns, right? So luxury vehicles, luxury models, fully loaded, high-end hybrid EVs. The demand for those vehicles are still looks like they're going to be pretty good. It may be the lower end of the spectrum, some of the economy models and for households that are a little more stretched and a little more pressured by inflation. Those are the households and those are the models that I think are going to face a little more headwind and a little more pressure as we move through the end of the year. So I hope this was useful. My email address is on these slides. Feel free to reach out to me if you have any questions. And for those of you that I see frequently in Kansas City, looking forward to seeing you again soon. All right, take care. Bye-bye.